virtual biz zones. And today we're going to be talking about managing business risk. My name is Sansia Campbell, and I am the Public Relations and Events Coordinator at the Jamaica Business Development Corporation. So our presenter for this morning is Ms. Suzette Austin, and I'm going to tell you a little bit about Suzette. Suzette is a chartered accountant with over 20 years experience in accounting, external audit, internal audit, risk and compliance, and she's currently the principal at Austin Professional Services. She holds an MBA from the University of South Wales and has extensive experience in assessing business processes and controls, enterprise risk management, financial and treasury management. She has also participated in the strategic decision-making process in a few of the organizations that she worked, which includes participating in strategy and committee meetings. Her experience spans 3 of the big 4 audit firms, KPMG Jamaica, Ernst & Young Jamaica, and PricewaterhouseCoopers. So as you can hear from her, she is quite knowledgeable to share with us this morning. So I want to ask you to make her welcome, and she'll go into the presentation now, and then we will have questions at the end of the presentation. Thank you very much. Over to you, Suzette.
Thank you. Good morning, everyone. Good morning, everyone. I'll be presenting on, I'm trying to share my screen, on identifying and managing business risks. Well, just to start, managing business risk may seem to be hard at first if you are trying to attempt it at first. But once you get it embedded in your organization, then it is not as hard. It normally starts at a project and then embedded in your system, in your organization system. I know the audience is a little bit varied, meaning owner manage as opposed to having employees. So I'll try as best as possible to speak to the audience here. I'm trying to share the screen. Are you seeing my screen? Hello?
Yes, Suzette, the screen is being shared now, so you can go ahead.
Okay, right. So identifying and managing business risk. Well, to begin with, I hope everybody is social distancing and keeping your families and yourself safe. In listening to the Prime Minister last night, I noticed that he had said he used risk a lot and risk-based approach. And as a country, that is what, with this epidemic, that is what the leaders have to be doing now. They have to be looking at their risk-based approach in terms of managing the epidemic. And in a business, identifying and managing business risk is no different. The key here in managing business risk is to ensure that you're proactive. You can anticipate the risk before it happens and not reactive. Even sometimes you have emerging risks, right? And these are risks that, based on what is happening, it may come into play. It's not a risk to your business yet, but you have to keep watching it. So therefore, it is important that we are proactive in managing our business risks. So what are business risks? And there are many definitions out there. This is one definition. Business risks are internal and external factors that will possibly happen which have a negative impact on your business that will prevent the organization from achieving its business objectives and to execute its strategy successfully. So you have a business, you know where you want to take it, you know what are the things that you are going to do to take it where you want to do. Say you want in the next 5 years, you want to double your business. You would have had strategies that you would come up with in terms of doubling your business. So the risk is that there are things that may be known and unknown that can prevent us from achieving those objectives. And so you want to be able to see ahead before it happens and to put measures in place, or sometimes we even have measures in place and there are gaps. We still need to tighten up a little bit. So it is important in one sentence to manage business risk so that it helps to prevent total business failure. So I'm going to go through some steps in managing business risk. First, as I said before, you have to understand your business goals and objectives of your business. What drives your business? So your sales process, what are the important things that you need to do to get your sales going? Who are your customers? What is your market? What are the type of expenses that you have that will incur in doing this? So you have to understand as to one, where you want to go, your objectives, the strategies, understand your business, and what keeps your business ticking or going. Then the next thing you need to do is to define and identify your business risk. And your business risk can be grouped in different categories. It could be a strategic risk, which is looking at your long-term goals. You want to double your business in the next 5 years. What are the things that will cripple that? Your operational risk, which will be your daily activities. What is it that you do every day in your business to get your business up and running and going? Do you have enough funds to keep your business going, your working capital, to pay your suppliers? Some of those things. If you don't have enough funds, then you may not be able to grow your business, and you may even incur reputational damages from your suppliers. Then you have, of course, your financial. You can group your risk in financial business risk. What are the systems that you have in place to ensure that you know what your numbers are and that you can really rely on your numbers? And then you have your compliance risk. You have the government regulations, taxes. You need to pay your taxes. Are you in a regulated industry? So it is ideal to group your risk. So this graphic here is basically showing you the different risks, how to group your risk, and the process in terms of managing your risk. So you have the risk identification, which we're going to go through shortly. The risk assessment. How do you evaluate your risk? What are the impact on your business? What's the likelihood of these risks occurring? And you have to do some assessment of the type of risk. And when you have assessed, then you have to decide, how am I going to treat these risks? Are these risks that I need to just not take on? Do I need to just avoid these risks because my business cannot manage it? Or do you treat the risk? Treat the risk is that you put measures in place to ensure that these risks are either reduced or mitigated, right? And you can also transfer your risk, like insurance. And then you monitor, you put systems in place to monitor your risk on an ongoing basis. So risk identification, what are the things that we can do to brainstorm, to understand the risk to your business? With each organization and with each industry, there might be risks that are unique to your business. However, there are some common risks that would be across all business. So your financial risk, and then again, that also that is based on the processes that are in place in your business. So in identifying your risks, first you have to take a step back and ask yourself, what could go wrong? What could affect my business from not achieving its objectives and its strategies? So in this process, then you identify the sources. What are the threats to your organization achieving its business and strategies? And a tool that you can use is looking at the big picture, which is your SWOT analysis. What are the strengths of your business? What are the weaknesses? What are the opportunities? And what are the threats? So the threats obviously would be the risk. And in understanding, doing that SWOT analysis, then you would know how the measures that you need to put in place to protect your business and to ensure that your business achieves its objectives. Then it is not only your strategic business risk. There are things that you do, your strategy is employed in your daily operations. And there are things that you do on a daily basis. So you may have your sales process, you have your credit and collections, you have who you purchase from, you have your key people, you know, where you're located, the different activities. And so in your daily operating, then there may be things that would prevent your operations from functioning optimally. So these are things that you need to look at when you're identifying your risk. Of course, you have to know your business, know your core processes, know what makes your business tick. And of course, you need to brainstorm what could prevent your processes from functioning effectively. And I gave some examples here. Example, your accounts payable, you pay your vendors. What could make you are not able to pay your vendors? Who are the persons that are responsible for payments? What are the checks and balances? Your sales. What could prevent you from not achieving the sales that you desire to achieve? Your credit and collections. What could prevent you from not collecting the amounts of monies that you expected to achieve, to get? What is your credit policy? Do you give 30 days? Do you give 60 days? What are the follow-up actions that you have to follow up on the persons who you give credit? Deliver to customers. How do you get your product to the customers? So you have to know what you do. In order to brainstorm, you have to know your core processes. And of course, you have to get collective perspectives. You, as an owner manager, if you're an owner managed business, you need to draw on other persons' expertise to say brainstorm this risk identification. Because the truth is that we all see things differently, and there are some risks that you may not have thought of that other persons may have thought of. So it is good to get a number of persons with different thinking. So with the different thinking, then you have the different perspectives, and it will only help to strengthen your business in identifying the risk. And as I said previously, you group the different kind of risks in your strategic risk, the operational risk, your compliance risk, your financial risk, and there's also one risk that I didn't mention is your reputational risk. Your reputational risk it's your brand, and so it can damage, one thing going wrong can damage you from going further into the future. And so that is a risk that you have to ensure that you consider and you manage. There are also theories out there that helps to analyze your competitive environment. And in analyzing your competitive environment, then you will be able to understand the impact of your environment, your competitive environment on your business. So you look at your bargaining power of your suppliers. Who are the persons that you are buying from? Do they have more control than you? Are you reliant on one supplier? Maybe you need to diversify. And I'll use an example that was recently in the news with the tourism industry just going down because of this epidemic. Then there was something in the news where this egg farmer, he mainly, so he sold to the tourist industry. And so he was reliant as for them as his customers, right? So you want to diversify your customer base, right? So if anything happens, then you are not reliant on one industry, one set of customers. So you look at your bargaining power of your suppliers, your bargaining power of your customers, and it's the same thing with your suppliers. You try and diversify as much as possible from your suppliers to see who you're buying from, who you're selling from. Threat of substitution. And in doing all of this, then you will understand your risk. Because if you are buying from one supplier, in your risk identification, you may say, you know what if this supplier cannot send me the raw material that I need? What if this supplier cannot sell me the products that I buy? Then it is going to cripple my business. So what are the measures that I need to put in as a business owner? I may need to ensure that I start purchasing. I have expand 2 or 3 more suppliers. I may need to expand my market, not only relying, for example, here at the hotel industry, but I may need to look at the supermarket, for example. So as to, if anything should happen, yes, you may have one income stream being affected, but then the other income stream will be protected. Threat of substitution. You have products there. How do you ensure that your product never goes out of stock in the market? Because what will happen if you have products that are easily substituted, and sometimes we can't get away from that. You just have to manage it. Then what is it that differentiates you? So your customers may choose to buy, if you're out of stock, from your competitor, the substitute product that they have. What is it that differentiates you? What is it that ensures that you do not run out and continue to have your brand there, where your customer will always, or most times, choose you? Threat of new entry. Within some markets, again, that you can't prevent, but then you can look to see, okay, am I operating in a market whereby it's easy for anybody to come and start up a business? And then you would know how, you would identify the risk, and then you would know how to put measures in place to try and mitigate or reduce the risk. And competitive rivalry. Who are your competitors? So who are your competitors? Who you need to ensure that you monitor closely and ensure that you keep the market that you need to have, and ensure that you expand how you need to expand. So these are theories that you can use in the risk identification process. And then you have your pest factors. The political, economical, social, and technological. Political, what's happening in the political landscape that can affect your business? So in looking at your political landscape, do you have a general election near? If you have a business that is prone to, income is prone to up and down based on political environment, then you may need to, you'll identify your risk, and what can I do in the event that there's political instability? Then you also look at your economic. You look at your inflation rate. Will there be a recession? If there's a recession, what will I do? You look at your supply and demand. These are all economic, and of course, technological advances. If you're expanding as a business, or you want to expand at a certain rate, is your IT systems, can your IT systems support you? And if not, what can I do to make it better? Are there processes that are manual that we're doing that will impact your productivity, that you could use technology technology to enhance it, so it reduce the time, it reduce the manpower. So all of these are just some areas, some things that you can do in identifying your risk. So what do you do after you identify your risk? Well, I have some risks here. Business interruption result in lost revenue, lost sale, and all of us will be faced with the COVID-19 realities. Some of us will be seeing some things. Now is a time to look and to see how we can structure and to see how we can re-engineer our business. But COVID-19 is just one, but there are other things on an ongoing basis that may interrupt your business. And the question is, you have to learn to preempt, see these, and put measures in place so that your business will have minimum recovery time. And I think somebody had dealt with business recovery sometime last week. Another risk, I spoke to government imposition of regulation, which can impact your plans and your market expansion. So these again are some examples of risks that I've identified. Then you have payments, you're making payments for goods not received. What are the things that you have in place to ensure that you are not making payments for goods not received? Who is the person that received? Who are the persons that receive it? Or who are the persons that can say, sign off on the invoices to say we actually receive this? Do you check it before you make the payments? Who are the persons that have access to your banking system? So these are examples of risk. Pilferage of inventory. What are the systems that you have in place to ensure that nobody steals your inventory? Do you have ongoing stock count? Do we have perpetual stock count, meaning counting the high value of the items more often than opposed to just looking at an annual stock count? Your data contamination. Do you ensure that you have the right people, restricted access, have access to your data? Is it that anybody can come and access your data, so you have to protect your data? So those are some risks. So in terms of managing your business risk, first you need to set aside time. It's a discipline that seems to be hard at first, but once you get into the routine, then you should be okay. So you could look at your risk, depends on how huge your business. You may look at it monthly, quarterly, annually, but the key is risk. Managing your business risk is an ongoing, but there are times that you set aside to say, okay, I'm going to look at risk in a structured way. The key is structure. And then after you have set aside that time, then you need after you identify your risk, then you need to assess and evaluate the risk. What do you do with these risks when you've identified? Do you mitigate them? Do you reduce them? Do you avoid them? In assessing your risk, you look at, okay, I have this risk. Let's say accounts payable, payments are made for goods not received. And you look at what you have, the likelihood of this happening in your business. Can we make payments? And this is just an example. Payments for goods not received, and you go and you score your different risks. Is it a rare? Is it unlikely? Is it possible? Is it likely? And is it almost certain? So this is a part of the assessment of risk. And again, I would emphasize that in managing your risk, you need collective perspective, because one person don't know everything. So especially persons that are in the business, and probably if it is an owner managed and you have limited persons, then you probably need to draw on other person. And after you have assessed the risk, then you need to look at the impact. This risk is likely. You have a risk, it is likely. The event will probably occur in most circumstances. and you gave it a 4. So then you need to step back and ask yourself, what is the magnitude of impact if this should happen? If accounts payable, bills are paid without goods received, what would be the impact on your operation? Is it insignificant? It will not cause any disruption or damage? And there's some guidance there. Minor, is it minor? Negative outcome from risk? Is it moderate? So you go through and you score each risk based on the likelihood of it happening in your business and the impact. Is it major? Right? And then after you have assessed your risk, you scored your risk, you have decided, you have said, okay, I have these risks. This is the likelihood of these risks happening. This would be the impact of these happening. And then I'll show you a risk scoring sheet shortly. And you come up with different scores for each risk. Then you need to take a step back again. All right, I have this risk. What are risk accounts payable, not goods paid for good, payments made for goods not received. And in a real world, real world, then you may have things in place to prevent this from happening. So the question is, what are the checks and balances that you have in your business to ensure that this risk do not come to reality? This risk do not materialize. And in looking at your different risks, after you've looked at the impact and the likelihood without considering the checks and balances, then you would identify some gaps. I have this control, this person does this, and we check off this. But you know, there is still the risk of somebody going through and change the banking information and it go to the wrong bank account. So in looking at your controls, then you would be able to identify gaps. I have this control, but it is not effective. And so it is critical that you look at the effectiveness of your controls. How effective are your controls in mitigating and reducing these risks? So what are internal controls? Internal controls are actions taken by management, the board, and other parties to enhance risk management and increase the likelihood that established objectives and goals will be achieved. So the risk, it will prevent your objectives from being achieved. And the controls will ensure that your objectives and goals will be achieved. So you cannot look at risk by itself. You have to look at the measures that are in place. And if you don't have measures, then you need to put it in place. If the risk is that material, to ensure that you achieve, at the end of the day, you want to ensure that whether it is the operational goals, which will tie up in your strategic goals, because there should be alignment, that you achieve what you said you're going to achieve. So internal control, so this is a little bit broad-based, but as an owner-managed company, you're probably the board, management and everything, right? So you set the tone, right? But as again, I'll emphasize, in managing risk, you need collective perspective. And so although you're owner-managed, then you should not limit yourself. You must have a team of people that you can draw on, because if you're really into business and you really want to expand and to do certain things, you may not see everything. And so as much as you may be owner managed, it is critical that you get that collective perspective. So here, this definition is broad-based actions taken by management, the board, and other parties. That is in a big, nice corporate company, but doesn't mean that with owner managed, you cannot set certain or have certain people that you would draw on to help you in doing managing your risk. So internal controls. The controls that you have are the checks and balances. You're able to communicate your vision, your value system, your objective. The controls that you put in place, or in other words, the checks and balances, protect your assets. It helps you to comply with your laws and regulations, so you would know that you need to pay over your employee payment by the 14th of the next month. And then you would have put in systems and places to ensure that you don't miss it, so you can avoid penalties and charges. It provides boundaries in terms of who does what, who is authorized to do what. Utilize resources effectively and efficiently. So in looking at your controls, you ensure that the right people are doing the right thing. Promote financial reliability and integrity. So one of the things that the banks ask for is your financial statement. So if in lending you, if they are comfortable that your financial data, you have enough controls to ensure that your financial data are reliable and it's basically accurate for most part, then that will help you. So that's what internal controls are. And internal controls, okay, a budget to sell $1 million. Set monetary results, but I sold 500,000. Why didn't we achieve the $1 million? So these measures that you put in place, and of course internal, to help you to understand your business. That's what internal controls. And you can see where it links to tying up your objectives. And of course, internal controls provide feedback. As I just used the example, you set out to sell $1 million, you sell 500,000. Then you assess what are the things that we didn't do right, what are the things that we can do. So when you have the systems in place, then it informs you, and then you can strengthen your business. So I have here some checks and balances, which is the same thing as controls that we can do. Of course, when you identify all risks, you will not be able realistically to monitor all risks. So when after you have scored your risk and look at your magnitude of impact and the likelihood of occurrence and your magnitude of impact, and you've scored them, then you need to decide, okay, based on the scores, these are our top risks. And with these top risks, we cannot afford for these risks to be mitigated. So what to be realized in the business? So what do we do? Do we treat these risks? And if you treat the risks, what are the measures that you put in place to ensure that you're constantly monitoring that you're taking the right measures? And then, or do you transfer the risk? You can transfer a risk. For example, you own a building, and insurance is one way of transferring risk. You might have fire, it's a risk. So you insure just in case. You can't do anything if a building catches fire. You can put things in place, but things happen. But in case, you insure your building and you make sure that the insurance is adequate. Another thing, you may not be able to have the manpower, the persons in place to do your financials, but you can decide to outsource certain things so that you have separation of duties because you don't have enough persons, or you don't want to take on that added cost. So you may decide to outsource, say your payroll, your finance function, anything. Inventory, this is another. These are just examples of some of the things that we can do for your inventory. You ensure that your goods received are checked and recorded on a daily basis. You ensure that this is difficult with owner management, segregation, but as best as you can, you need to ensure that there are adequate checks and balances, that the person, whoever is receiving, is not necessarily issuing, or you have, make sure that you do your regular inventory count. Yeah. If there is a limit with manpower, you're always counting to ensure that what you should have, especially a high valued item, that is what What you should have, that is what in actuality is. You sell your goods, you make sure that you invoice the goods on a daily basis. Don't wait until month end, or don't wait until half year. So these are things that you can help to strengthen your system. And then you have your invoices, goods received and purchase orders are matched and authorized. So payments, all payments are filed in date and sequential order, and documentations are safeguarded. Checks, wire payments are authorized by two persons with the delegation of authorized limits. So let's talk about limitations, say in an owner-managed business. You may not have two persons that can authorize, but the key is that you as an owner, even if you have employees, you should ensure that you handle certain things, especially if the business is small. So authorizing your payments, you may want to take on that. Delegation of authorized limits, you might say, okay, for anything under $10,000, whoever you have working with can go ahead and authorize it. But anything over $10,000, I need to do it. And our two persons need to look at it to make sure that everything is okay. Again, to continue with the checks and balances, you need to ensure that adequate, and all of these are in the context of managing your business risk and ensuring that the controls are in place. So in looking at your risk and you identify them, then these are the things that you would probably have in place or put in place if you don't have. These are some of the things that will come up, how to strengthen. For example, adequate record filing system. You pay somebody, you need to ensure that it can be easily retrieved. So for verification, let's say if the tax persons come in, how do you ensure that, and they want to question certain things, that you have a proper system in place to retrieve your documentation? You have policies and procedures in place, and these don't have to be elaborate. These are just giving guidance, yeah? Your finance, your credit, your sales and collection process. What guides your business? What guides how you do what you do? Who are the persons that are authorized to do certain things? Then you have restricted access. I spoke about data contamination before. And you need to make sure that, okay, your system is password. And restricted access is not limited to systems. It is limited to physical control too. Who goes into the cashier area? Who are the persons that are authorized? What is the system that you have in? Who are the persons that are authorized? Sorry. In terms of data access, who are the persons that have access to certain information? So everybody have a password. You have password on your system, but not only that, for the different areas, is it that everybody can see everything? Is that how you want to manage your business, or you just want to ensure that your employees have information to the areas that is relevant to their job? Another checks of balance is delegation of authorities. I spoke about that before. Who are the persons that are authorized to do certain transactions? Segregation of duties, and I have challenge here. I keep going back to the owner managed, because the owner managed may have limited staff. Then this is a challenge, but what you need to do is to ensure that when identifying your risk, as best as you can, ensure that the controls are in place. Bank reconciliations. Why do you do bank reconciliation? To ensure that what you say went into your bank account is actually it. Any differences, you probably need to look at your system as to why is it that the bank don't have it, or why the bank has something and you don't have it. So it is important to you do a bank reconciliation. You need to, you talk about the financial integrity. What are the systems that you ensure that you have your monthly management accounts? If it is owner managed, it is ideal to do your monthly management account. You may decide to do some financial information on a monthly and some on a quarterly. Again, that is based on your business operation. So everything would have to be structured according to your business operation. And in the risk identification, then you would know what are the things. These are just some examples, things that you need to put in place. You need to ensure that your documents are pre-numbered. Your sales invoices, your purchase order receipt, and of course, compliance with tax authorities. So after you have looked at your risk, you have identified your risk. So we started from the business objectives. Then we've identified our risk. We have scored our risk. Then we have looked at our controls that we have. We have scored our controls, whether they're effective or not effective. And we look to see if the controls can be strengthened. Then after that, we look at, after we have taken into consideration the risk scoring, the risk scoring, the controls, then we rescore our risk. With all these controls that are in place, and this is all in the assessment stage. What do we do with these risks? And I've said before that you cannot chase all risks. You cannot monitor all risks. It's not practical. But the risks that have the highest score or near highest score, you need to ensure that you have them on your radar. And the truth is that there are some risks that may be low. You may have emerging risks. For example, government may be drafting regulations to regulate your industry. So normally you would operate freely, but now an emerging risk is that they decide to draft regulation because there needs to be some form of structure and accountability. Then that would have scored probably low down the risk radar, but then you keep watching it because that can now become a high risk. So that's why the constant monitoring is important, because not because a risk is low today, it means that it will always be low. Risks are evolving. So after you have looked at scored your risk without the controls, you've looked at your controls, you look at your gaps, then you decide, as a business, do I accept that no matter what I do, I'm going to have these risks, because you have risks that are inherent to your business. For example, you're in the business of manufacturing and your wastage in your production line. No matter what, we're going to have wastage. But however, you may say, okay, we accept that wastage should be no more than 1% of your production costs, for argument's sake. So you've accepted that. But then if you have wasted more than 1%, then you need to understand what is happening. That's just an example. And so you take the risk, you either transfer it, I use insurance before as an example, or you treat it. Treat it by putting the controls in place, and you constantly monitor it. And then you terminate it, you avoid the risk altogether. So these are some of the actions that you can take in managing business risk. You decide to take it, the risk, after you looked at all the controls, and you rescore it. You transfer the risk, you treat it, or you terminate it. So again, I said, which risk do you ensure? This is something that you have to ensure that you do ask your business based on the score. Which risk do you ensure that you always monitor? You cannot realistically monitor all the risks. Which risk that would cripple your organization, and you have to always make sure that you have systems in place to ensure that these risks don't come to reality. This is just an example of how you score. When you look at the likelihood of your risk, and here you have on the horizontal section at the top, you have a risk. It's rare. If it's rare, it's 1. If it is likely, it's 4. If it is almost likely, then it is 5, the highest score. And then As I said before, in assessing it, you look at the impact. Is the impact extreme or insignificant? Extreme would be the highest five, score of 5, 1 insignificant. And then you multiply it. So for example, if it is risk is almost certain and you have a score of 5, but however, impact, let's go. If the risk is, let's look at the likelihood. The risk is 4, likelihood, and it is catastrophic, 5. Then it will come as a red. It's a high risk. It's 4 times 5, gives you 20. So this is a risk that you say, you may decide to avoid it or you may decide to treat it. Depends on the business, have to decide. But this is something that you can't drop the ball on, in other words. If it is rare, 1, it may not happen. It's a risk to the business. And if it happened, the impact may be great. So, but the scoring is low, it's 5. That is something that you would probably look at in your annual review, because the risk can emerge, but you may not need to monitor it. You need to monitor the highest one. On this graph here, it would be those in the red and the 20 and the 15 and the 12 and the 16. So as a business, in assessing your risk, impact, and likelihood, this is a good way of scoring your risk, because you need to score your risk in order to know what to do, how to monitor them. You score it before you look at the controls, and you score it after you look at the controls and to see how you can strengthen your control. So tips for identifying and managing risk. First and foremost, you need to implement a process for managing risk. And it may sound really nice to implement a process, but process can be simple based on your business, right? A owner he just needs to set aside time and to get the right people to help him to brainstorm. So you might say, okay, every month, every quarter, you're gonna look at the risk, right? After and annually, you may look at it by the different sections, and annually you look at everything. But there needs to be a process in place. Then the next thing that you need to do is identify the risk, which we have gone through. Right? All of these we have gone through. This is just a recap. Sorry. You identify the risk to your business, rate and score the risk, and I gave you 2 graphs there, 2 maps. You rate and score the risk without the controls, without the checks and balances, and you ask, what's the impact and what's the likelihood of these risks happening? After you have scored them, you look at what are the checks and balances are in your business that will prevent these risks from happening. And then you score the controls on a scale of 1 to 5, with 1 being the lowest and 5 being effective. Whatever checks and balances that we have in the business, are these effective? Are these necessary? Because sometimes some businesses say that they have controls in place, but they are what you call redundant controls. They're not necessary. It's something that somebody was doing some time ago and they keep on doing it, but the business has evolved and have changed, and all it does is take a person's time. So in doing the managing business risk, you will identify this. Do we need to still do these? Is there a better way? And you identify the control gaps and implement measures to close these gaps. How do you ensure that we strengthen the checks and balances that are in our business? Then you re-rate the risk, that is residual risk. And you determine the actions to be taken for risks with the highest scores. So as I said, you don't chase all the risks, but definitely for the risks with the highest score, you need to know what are we going to do? What measures are we going to put in place to ensure that these risks do not materialize? You may decide to pass it on, transfer it. And if you decide to treat it, and that is a measure that you would have taken. If you decide to treat it, your internal systems, your checks and balances should be able to mitigate or reduce these risks. And ensure that you always constantly monitor the process in place. Risk management, managing your business risk is not a one-time, it's an ongoing process. A risk today that is small may not be, may be a huge risk next year. Risks evolve. And so the constant monitoring process that you put in place is important. And lastly, managing business risk should be in your DNA as a business. You should all embedded in your processes. You should always be thinking about risk, not for it to cripple your business, but for it to enhance your business. Because some persons may look at managing your business risk as crippling your business. No, there should be a balance. You may decide to take certain calculated risks, but measures should be in place to mitigate the risk that will prevent you from achieving your desired objective. Risk managing your business should be embedded in your daily processes. It should be a part of your DNA. There is this graph as a reminder in terms of managing business risk. You look at your key business goals, you identify your risk, you do your risk assessment, you group your risk, you identify your risk, you look at your risk assessment, how effective they are, the likelihood of them occurring, the impact on your business, what are the controls that you have in place, you score them. How do you treat them? You transfer them? Do you tolerate them? Do you accept them? You monitor and report, and it goes round in a circle. It continues. It's a process. The end. Questions?
All right, thank you very much, Suzette, for that very informative presentation. We are now open to take questions. You can either hold up your hand by clicking on the participants button in the middle of the screen and raising your hand, or you may post a question in the chat and we will get the question from there. Someone is wondering how we'll get the slides. The slides will not be provided. However, the presentation is recorded and it will be available on the JBDC's YouTube page. That is youtube.com/JBDC Jamaica. And you can access that by tomorrow, I think. So you'll be able to replay the presentation as many times as you. Any questions from anyone? You know what that means, Suzette? That means you were as clear. Okay. Someone is asking a question. Go ahead, Susie, with you're gonna type it. Just says my question is, can you give a real example of, and it stops right there, Susie. So, okay, of a risk that evolved.
A risk that evolved.
Okay. Okay, so she's asking, can you give a real example of a risk that evolved over time in a business?
In a business. For example, well, the fraud risk is always there, but you may decide decide that you have enough controls in your business to prevent fraud from happening. For example, you're an owner-managed business now, right? And you would have been reviewing all the payments, and you would have had access to the bank account, right? Now, your business is growing, right? And so you would have scored it because you're saying, I'm the owner, and so I look at all the invoices and I ensure that the payments are correct. However, your business have grown and you decided to employ somebody to help you. That person also, you have authorized a person to look at your payments and just to make the payments and can write the checks. That person also does the bank reconciliation. That person also does the collect from customers. Now, if you have that trust, and I'm saying you're not supposed to trust your staff, but you need to put the controls in place. If you have that trust and because you're operating as when you were the only person in your business, but you have now employed person and you have given that person that attitude to do a lot of stuff. The bank recon, collect from customer and make the payments. That person can do a fictitious payment, so that they received the goods, they didn't receive the goods. Person doing the bank recon can hide it because they're doing the reconciliation, and they can swindle the money to their bank account. So there's a fictitious vendor. That is fraud. Now, when you would have assessed it initially, you would have said, no, I am managing everything, so there's no risk of fraud. But the business evolved, and so did the risk. They didn't put measures in place to ensure that the person who is making the payment cannot do the bank reconciliation, right? You didn't put measures in place to say that, okay, I give you the latitude to make payments below a certain amount, but anything above a certain amount, me and you or me alone, I have to look at it. That's a real example. And so that person could be defrauding your company or business by swindling money to their account. I'm not sure if but that's a good example. But I'm not creating any mistrust. But the truth is that we put controls in place to reduce and mitigate the risk. So business evolve and so risk evolve. So as an owner manage, once you grow, then you need to ensure that you put the measures in place. And that's a real example that can happen.
All right, thank you very much, Susie, for your question, and Suzette for your answer. So I guess the thought coming out of this is that there must be checks and balances so that you can retain control of the business.
Yeah.
I know that there are no additional questions, so we're gonna end here for today. Thank you so much, Suzette, for having joined us and for all the fantastic information that you provided on managing business risk. Just want everyone to know that JBDC is still open. We are operating virtually and we are available to answer any questions our clients may have. I've posted in the chat the direct link that you can sign up on, and a business development officer will make contact with you. I'm also going to post our email address and contact numbers so that you can go ahead and make contact with us there as well. And we're also available on social media, very active on Facebook and Instagram. You can follow us there and find any information that you need on us, as well as all the presentations that we have done so far, whether it's the virtual Biz Zone or the In Concert series or the Entrepreneur's Journey. They're all available at on our YouTube page All we ask that you do when you go on, subscribe, and then you'll have access to all the videos there. Once again, thank you very much, everybody, for joining us this morning. Thank you, Suzette, for having given us such a wonderful presentation. And to everyone, have a fantastic rest.